Hi, Tim Shapter again from Smart SMSF Solutions, and hopefully before you watch this video you would have watched the first two videos, the first one explaining superannuation in general and the second one explaining how a self-managed super fund buys an investment property. So this video here, I'm just going to run some numbers to give you a bit of an idea of what you can expect. So if you watch the second video, we worked on a $120,000 balance in the self-managed super fund, and we worked on an investment property at $400,000. So let's stick with that as we do this. So we've got self-managed super fund has $120,000 in the fund, and let's say that we have mum and dad with a combined income of 120,000, so that could be 60,000 each, 80 or 40. Not too worried which way we do that. And we're purchasing a property for $400,000 with a rental return of $400. So typically we would use $1 per thousand as a reasonable basis for an assumption. So mum and dad both on both combined incomes of 120. They're going to get employer contributions at 9%, and the after-tax cash flow to the super fund will be, because we've got to take out 15% tax, will be $9,180. Rent at $400 a week, $20,800. So we'll work with that. And we also, in the last video, we showed an example where the loan was $320,000, and let's say an interest rate of 6%, which equals $19,200 in repayments. Okay, so let's run some numbers on this. So if we work out the income, employer contributions are actually counted as income to the fund. So we've got 9,180 plus the rent, 20,800, which equals $29,980. So that's what's coming into the fund. So let's work out the expenses. We've got interest equals 19,200 plus, let's say rates are 2,000, insurance 1,500, and the cost of running the self-managed super fund. So we'll allow 2,300. So there we've got expenses equals interest repayments on the loan, rates, insurance, and the cost of administering the self-managed super fund, which hopefully comes to 3.5, $25,000. So you can see there, when we look at the returns, got income equals, we've got 4,980. So that's what income is flowing into the fund. So when we talk about investment property and returns, there's really two types of returns. The first one is the cash flow or the income, and the second one is the growth of the property. So while it's not going into our cash balance, it's certainly increasing the value of our super fund. So typically you'll hear numbers around 6 to 8% bandied that property will grow at 6 to 8% per annum. But let's be conservative and let's work on 4%. So growth, if we say the property's worth $400,000 and it's going to grow at 4%, would be a return of $16,000. So there we've got $20,980 return in our first year. So again, to cover off, got a self-managed super fund with $120,000. Mum and dad combined income of $120,000. Their 9% equals $9,180 after tax. Property worth $400, rent of $400 a week, and a loan value of $320,000 at 6%, which equals $19,200. Our income into the fund is the $9,180 plus the $20,800. So the employer contributions plus the rent gives us a combined income of $29,980, and our expenses are our interest payment, $19,200, plus rates, $2,000. We've allowed $1,500 for insurance, and the cost of administering the fund, such as accountant's fees, $2,300. So our combined expenses is $25,000, which gives us an income return of $4,980. And we're assuming that there's a growth rate at 4% per annum, which would give us $16,000, and that gives us a total return of $20,980. So when we work this out as a, and I'll just rub some of this out, when we work on a return of income, return on investment, it's simply $20,980 divided by the actual money that we used to purchase that property. And the example there is we used deposit of $80,000, which is the 20%, and costs $20,000, which equals $100,000. And I don't even need a calculator for this. $20,980 divided by $100,000 gives us a return on investment of 20.98%. Arguably better than our industry and retail funds. So, and that really shows the power of leveraging, and especially leveraging in your self-managed super fund, where potentially you're not going to pay any capital gains tax, which actually has quite an impact on the end result of your returns. So I hope that sort of explained in enough detail, along with the other two videos, for you to be able to make an informed decision about whether a self-managed super fund with an investment property is right for you. If you need any more information, please call our office on 1300 761 685, and we'd be happy to talk to you in more depth. Thank you.